Okay, so picture this, right? You know that that store you love, the one with clothes you basically do anything for, and suddenly, bam, flash sale. Everything's marked down like crazy discounts. That's kind of what a market dip is like, except instead of like designer jeans, it's stocks, maybe even a piece of Apple or Nike. And that's exactly what we're diving into today. How market dips, while maybe a bit scary, can actually be like huge opportunity. We've got two sources to kind of guide us today. Some timely advice for investors during, a downturn, and then to see it all in action, a snapshot of the actual market news from today, October 1st, 2024.
You know, it's interesting. You see a sale sign, most people, they get excited, right?
Yeah.
But a lot of investors, they see a market dip, and it's like panic sets in. It's that fear factor that often keeps people from making, well, really smart moves.
Oh, totally. Like our first source, they throw out some pretty specific strategies. Things like averaging down, buying puts. They even mention put debit spreads.
Yeah.
Okay, I kind of get the whole buy low concept, but help me out here. What are these strategies really about?
All right, let's break it down. So averaging down, it's basically like you're doubling down on a stock you believe in, but it's temporarily on sale.
Hmm.
Imagine this. You bought, say, some coffee beans last week. Now they're half price. You'd buy more, right? Same idea here. By buying more at a lower price, you're basically lowering your average cost per share. And what does that do? It sets you up for a better return when the price bounces back, which, it almost always does eventually.
So you're kind of playing the long game here, not getting spooked by the short-term dip. Okay, that makes sense. But what about buying puts? That one sounds a bit more Wall Street.
It's actually pretty intuitive when you really think about it. Imagine you could buy a rain check on a stock. But instead of it guaranteeing you a certain price on something you want to buy later, it guarantees you can sell at a set price. That's like basically what a put option is. You think a stock might go down, you buy a put. And if you're right, and if it drops, you can actually make a profit. It's kind of like hedging your bets, especially if you're, a little unsure about where some of your other holdings might be going.
So it's a way to potentially profit from the dip itself, not just try to avoid losses. Interesting. Now, that brings us to put debit spreads.
I'll be honest, that one has me completely lost. Think of put debit spreads as like a slightly more advanced move. You're still using those put options we were talking about, but now you're creating a whole strategy, one that tries to like limit your risk. It's kind of playing both sides of the fence, but with, a safety net underneath you.
Okay, so we've got these potential strategies for like navigating a downturn, right? But our first source, they kept like hammering on this idea of the psychological game of investing. They even used some pretty dramatic language like talking about a car crash and warning people don't get tricked. Why so intense?
Because investing, it isn't just about numbers. It's about really understanding how our own brains work. We are hardwired to react, like emotionally, to market swings up or down. And that car crash feeling they were talking about, that's real. And it leads to a lot of impulsive decisions. Having a strategy and sticking to it that helps you tune out all that noise and focus on, the long game.
Which brings us to our second source, the market news. As of today, October 1st. And it's a bit of a mixed bag out there, wouldn't you say?
Indeed. On one hand, you've got this U.S. dock worker strike that's still going on.
Yeah.
Major supply chain disruptions, lots of unknowns. And you know what investors really hate? Uncertainty.
Yeah, that makes sense. Uncertainty equals risk in a lot of people's minds. But here's where it gets really interesting to me. Our news also mentions that Apple's stock is like about to hit all-time highs. Apple in this market.
And that, my friend, is a perfect example of why psychology is so crucial to understanding the market. You see, in times of, turmoil, what do investors often do? They flock to what they see as safe havens.
Hmm.
Apple, whether it's truly safe or not, has that reputation. It's like the financial equivalent of, I don't know, comfort food when there's a storm raging outside.
So even in a dip where like logically maybe everything should be down, you've got this whole flight to safety thing happening and it's pushing certain stocks, UP.
It's a fascinating paradox, isn't it?
Yeah.
And it really speaks to the fact that market dips, they're rarely, uniform. There are always these outliers, these stocks that are like bucking the trend. And that's where the real opportunity can hide if you know where to look, of course.
Right, and knowing where to look means what? Understanding those like underlying currents, not just the news itself, but how people might actually react to it.
Exactly. Which brings us to another interesting little tidbit from our market snapshot. Nike, apparently they're looking at potentially declining sales this quarter.
See, this is what makes me nervous as an investor. If a company like Nike, I mean, it's a household name, a blue chip. If they're hurting, doesn't that, like, signal something bigger about this whole market downturn?
It's tempting, isn't it? To connect those dots, see one company's struggles and think, oh no, it's a whole market.
Yeah.
But here's where that critical thinking we talked about earlier, that's where it really comes in. One company's performance, even a big one like Nike, it doesn't necessarily tell the whole story. Remember, every company has its own, unique set of factors at play.
So we shouldn't necessarily hit the panic button just because Nike's sales are down.
Exactly. It's all about context.
Yeah.
Now, if we start seeing like widespread sales declines across multiple sectors, okay, that's a different story. But for now, it's more important to focus on those strategies we discussed, remember, like averaging down.
Yeah.
This could actually be a prime opportunity to buying into a really solid company like Nike at a discount, assuming, of course, you believe in their long-term prospects.
So this market dip, combined with Nike's news, could actually be a buying up opportunity for someone who's been wanting to, get in on that swoosh action. That's a perspective shift I was not expecting today.
And that's precisely the point. This dip, like any dip, it's not some automatic cause for alarm. It's an opportunity, a chance to, reassess your portfolio, revisit your strategy, and just see, are there any adjustments that need to be made?
Okay, so we're not panicking, we're strategizing. We're not selling off everything. We're potentially buying, even if it feels counterintuitive at the moment. But how do we balance that with, the very real emotional side of investing?
That's where having a clear plan and really understanding your own personal risk tolerance, that's crucial. And that, looks different for everyone. For some people, it might mean having a financial advisor, someone they trust. For others, it might mean setting really strict limits on how much they're willing to invest or lose, for that matter.
So it's almost like having a prenup with your own emotions,
Yeah.
right? Knowing where your boundaries are before you get into the thick of it.
Exactly. Because when the market takes a dive, and it inevitably will, you don't want to be caught off guard. You don't want to be making rash decisions based on, fear. You want to be able to look at your plan and say, okay, this is just part of the process. I'm prepared.
So to bring it all back, that for our listener who might be listening to this right now, phone in hand, maybe checking their portfolio and feeling a little unsure about all this, what's the big takeaway from our deep dive today?
That uncertainty you're feeling.
Yeah.
That's totally normal. Market downturns, they just have this way of, making even seasoned investors feel a little jittery. But the key is, don't let those feelings take over. Don't let them drive the bus.
Right.
Remember that image we talked about, the flash sale at your favorite store? This dip, it's kind of like that. It's not a signal to just run away. It's a chance to maybe score some really great deals.
Yeah, and like any good shopper knows, you've got to have a plan before you hit the sales floor. You wouldn't just grab everything in sight just because it's marked down, right? You'd focus on what do you need, what have you been wanting, and importantly, what actually fits your budget.
Precisely.
Yeah.
And this is where those strategies we were talking about earlier, they come in. Averaging down, buying puts, even those more complex put debit spreads.
Right.
They're all tools, tools in your toolbox. Which ones you use and how you use them, well, that depends. Depends on your individual goals and, of course, your risk tolerance.
So it's about being informed, not just reacting, purely emotionally. And part of being informed is understanding that these dips, they're just a normal part of the whole market cycle.
Absolutely. What goes up must come down and, vice versa. It's that ebb and flow. That's what actually creates opportunity. Think about it. Some of the biggest names out there, the Apples, the Nikes of the world, they've weathered their fair share of downturns, right? It's how they responded, how they adapted. That's what set them up for long-term success.
Speaking of adapting, our market snapshot, it did mention that all of this is happening as we head into, the fourth quarter of 2024. Now, historically speaking, Q4, that can be a bit of a wild card, wouldn't you say?
It can. We tend to see a real mix of factors at play in Q4. You've got holiday spending, you've got those end-of-year reports coming out, investors are repositioning their portfolios. Some years, it's a Santa Claus rally, Other years, it's a bit more, subdued.
So does this particular downturn, the fact that it's happening right as Q4 kicks off, does that make it more significant, less significant? I guess that's the million-dollar question, isn't it?
It's definitely something to, to keep an eye on.
Yeah.
History, it can be a guide, but it's never, ever a perfect predictor. The best thing any investor can do is Stay informed, stay disciplined, and just remember, like that flash sale at your favorite store, those opportunities, they don't last forever.
Ooh, great advice to end on. Don't panic, have a plan, and maybe, set aside a little fun money for those sale prices. As always, thanks for joining us for this deep dive.